Code 3 Americans, welcome. I want to do a quick video showing where some opportunities are coming, I believe. A lot of people are talking about the doom and gloom. The stock market's up and down, crashing. It's down a significant percentage from its highs, probably still overvalued based on anything that makes any degree of economic sense. But so a lot of investor sentiment is negative. However, I think those looking for opportunity would be pleased to see there's likely some significant opportunities coming. I want to take a quick minute to show you why that might be and actually show you the math. I was just in Dallas, Texas here a couple weeks ago, and I was having lunch with Victor Menasce. I've had the privilege of being around Victor a number of times. Victor's a large developer, has a Real Estate Espresso podcast, which I recommend you listen to in the mornings. It's like a 4 or 5 minute podcast every day. Always has some nugget of information in there. But Victor's an outstanding educator and, again, a significant player in the real estate market. So I can't say enough about the man. Amazing teacher, amazing human being. Had the privilege to be around him and hang out with him a number of times. And anyway, what we were talking about at our last or the last time I seen him, we had lunch, is it was at an event. And I was asking him at lunch about a property that I've been looking at that I think has some opportunity in it coming down the road. And he agreed that absolutely, based on what I described, the folks that have that property are probably in some trouble. And he said, actually, I'm getting ready to do a presentation after lunch on this very thing and show some math to people and why this is happening or will be happening. So I just wanted to bring that to you, but complete credit to Victor Menasce. This is all his. But really wanted to include the visuals. Just take a few minutes here, but I think you'll be able to really ascertain why there is some great opportunity on the way. So Victor did a presentation and he was showing kind of then versus now. And if you look at over here a year ago, this would be an example of a deal, maybe an apartment deal or a value add deal. And so nobody's left behind. What that means is maybe you acquire the deal for a price, which you can kind of see over here what the bridge loan would be. And you intend to remodel the project or update it in some way with hopes of pushing rents up and ultimately refinancing out of it and collecting your cash and keeping into permanent financing. Well, essentially, there's a lot of this been done in the last couple of years in very low interest rate environments. And that's what this is referring to here, where it says bridge loan. Bridge loan is just what it sounds like. It's to cross a gap between where you are now to maybe do a remodel or value add or something to get to permanent financing. But the goal for these investors was always and is to get over here to permanent financing. The problem is the environment has changed very much. So maybe a year ago when they put this project together, as Victor explained, they were paying 8.75% on their bridge loan, but they were expecting to get into permanent financing at 3.25%, say. What they would expect to do is have a debt service coverage ratio of 1.18, meaning it's debt service positive. It brings in more money than what it takes to service the debt and expenses. And what the investors on this example he used would hope to do is do all the work, rehab them and rehab the property and so forth, and refinance out at about $5.6 million. In other words, they would scoop that equity out of the project and during the refinance and return some of that capital to investors that fronted some of the money to go into the project, and then they would be in a permanent loan. However, look what happens if you use the exact same numbers over on this chart at a 6% interest rate environment. Over here, they would be shooting for a pretty common 80% loan to value. They'd be borrowing 80% of the value of the property. If they tried to do that over here, notice the debt service coverage ratio at 6% is negative. That means it does not generate enough income to pay the debt and the expenses and so forth. So this is negative. A lender is not going to loan on this. And the problem with that is bridge money is not intended to be long-term money. So they're going to have to refinance or negotiate their way out of this bridge loan position and into a permanent financing position, and this isn't going to work at a 6% environment, which is probably even higher than that now. So let's take a look, just to really show the example Victor was illustrating, or to make the point of Victor was illustrating. Let's say they got into a 6% loan to value, or I'm sorry, 6% interest rate. But look at the loan to value, 56%. It would be all the way down at 56%. So instead of getting on this example, a $39 million loan, they'd get a almost $28 million loan and have a much lower loan to value. That means here, if you look at cash on refinance, instead of pulling out almost $6 million in cash to return to investors, they're going to have to go back and ask investors for a capital call. They're going to have to bring extra money to the table to the tune of about $6 million. This is not going to make many people happy. Then you look over here and you say, okay, well, what would it take to work? And Victor was showing that to get back to a debt service coverage ratio of 1.18, which is what we were up here, which is probably what they underwrote or planned the deal to be when they started. To get back to that, you'd have to be at about a 4.35% interest rate, which isn't available today probably, and then a 69% loan to value. So you're still not taking out near the amount of debt to value than would have been intended. So this is going to be a problem, and it's also going to create opportunity, because these buildings, these projects could likely go on sale depending what happens. If it takes a while for the Federal Reserve to get the inflation under control and they keep having to raise interest rates and they don't retreat, which could happen. There's already some weaknesses showing in England and in Europe, and over there they kind of pivoted a little bit. But we'll see what happens if this goes on for a period of time and these investors that had these projects run the clock out on the bridge money, the temporary financing, the clock runs out and they're not willing to hold those loans anymore, and they can't get the permanent financing because perhaps maybe investors don't want to place additional capital, they can't answer the capital call or whatever. You can rest assured banks aren't going to want these things to go back to the bank. Banks don't want to own real estate. So this is just an example, and there's probably a lot of projects out there like this that have materialized in the last couple of years. I believe we're watching one right now. We'll just have to see. It's kind of a canary in a coal mine. I've been saying that for a couple months, and Victor happened to agree with me over lunch there. So anyway, I wanted to point out that this is why specifically there's probably some opportunity coming for those paying attention and getting in position to capitalize on it. So, Victor threw this slide up at the end, and he said, "What are you going to need? You're going to need knowledge, which we offer that in the videos we create. If you go to our website, code3assets.com, there's a whole list of podcasts and books and YouTube channels you can watch, kind of a shortcut to start getting information from very reputable, qualified people. So it's kind of a shortcut. We don't get any affiliate fees or anything out of that. It's just a super great condensed resource for people to get started. So Victor says you're going to need some knowledge. You're going to need some emotional fortitude. As Warren Buffett says, be greedy when others are fearful and be fearful when others are greedy. Well, people are going to they're starting to get fearful now. This is a great time to get in position. I've had meals with Kenny McElroy, a very iconic real estate investor, and he'll tell you he made most of his money in the downturn in 08, coming out of 08, 9, 10, 11, and 12. Still owns most of those properties. There's some great opportunities at that time. And then the other thing you're going to have is the right environment. You get in that by showing up at meetups. We host a monthly meetup. You start building relationships, getting information. You can go to other investment meetups. You can go to investment conferences. If you go to our website, there's a list of those that are other people's events and so forth. So there's all sorts of opportunity if you know where to look and you're prepared to take action. So wanted to let you know, I wanted to show a specific example that Victor had shown us an event a couple weeks ago. And, as Russ Gray would say, host of the Real Estate Guys radio show, my good buddy Russ would say, the math is the path. So just look at the math, That's going to give you the path to where you need to go. And depending on which side of the trade you're on right now, that could be good or bad. So anyway, if you want to join the community, if you want to get our newsletters, if you want to stay plugged in, just email community@code3assets.com, and you'll make sure that'll make sure you get on our email list. We don't sell those lists. We don't do anything like that. We just send out informational newsletters and let people know when things are shifting or what we see coming. So anyway, with that, hope everybody has a good day. Teams up. See you next time.